Hello, I'm Paul Tustain, and I'm going to be taking you through a presentation to explain why I think gold is materially undervalued, even now, after 6 years of almost continuous price rises. Just so you know who I am, I founded BullionVault.com back in 2003, mostly to help the British people buy back the country's gold reserves, which our crazy government had just sold at the bottom of the market, for about $270 an ounce. BullionVault now has more gold than most central banks and is the world's #1 choice online, which I believe is because we offer a very transparent, no-nonsense approach with unbeatable prices. That's also why we're the only retail gold investment program invested in and recommended by the World Gold Council. If you don't know them, that's the organization which develops the physical gold market for 16 of the world's largest gold miners. But I'm not here to talk about BullionVault, so if you want to know more about it, or me, you'll have to click on the presenter link, which should now be at the top left of your screen. I'm here to talk about where we are in this current bull market in gold. As this chart shows, in 5 years it's risen from $500 to $1,400 an ounce. Most people can't bring themselves to buy something on the back of a price rise like this. That's why when currencies collapse, there's only ever 2 or 3% of people who escape the downward spiral. What I'm going to do today is show you the evidence which I think shows we're in that spiral now. I'm going to start with the fundamentals of gold: supply, demand, uses, long-term production, where the world's stock is, mining output and exploration success over the long term. I'll also cover what historically has killed off gold bull markets in the past. Then we look at debt. We look at the numbers and the incredibly unstable situation our governments have led us into. I've also got to talk about broader commodities. I'm going to show how energy and food commodities are going to force our Western hands, shrinking the buying power of our savings and dramatically reducing our standard of living. Then I'm going to paint what I think is a credible picture of uncontrollable Western currency devaluation. Currency credibility is the bedrock of most of our financial plans, but it's only when we seriously question whether our currency deserves its status that we can make the difficult transition to understanding that we must no longer accumulate money, but dispose of it in favour of something else. Just think for a moment what a difficult transition that will be for most of the people you know. That's why in times like these, so many ordinary, decent people get left behind, with their life savings decimated. Finally, we value gold. It's notoriously difficult to value gold because it doesn't generate a cash flow. But I'm going to show you how to do it by looking at history, risk and reward. I shall be taking you through my methods and my data sources. The whole idea of this is that you can use my model yourself. If you disagree with my risk estimates, and I expect you will, then just change them and produce your own value for gold. It's incredibly important to have in mind a value yardstick when you buy gold or indeed anything else. Sharing with you how to calculate that yardstick is the main point of this presentation. By the way, I warn you, the value I calculate is far in excess of the current price, even though, as I hope to show, I'm being sensible and cautious with my figures. The bottom line is that our governments have behaved very irresponsibly, and we're now not so different from the banana republics which have lurched from crisis to crisis over the last 100 years. I think our future is likely to be a bit like their past. I wanted this presentation to be shorter. I've asked lots of people what I should cut, and with their help, we got the presentation down to about an hour. I know it's too long. I just hope you've got some enthusiasm for the subject and a mug of coffee by your side. Okay, so let's look at the fundamentals of gold, starting with just how rare it is. The cube of gold in this slide has an edge of 20 meters, so you can see it doesn't quite cover a tennis court. And at 166,000 tons, that's all the gold that's ever been produced in the history of the world. The cube is growing because of mining output at the rate of 1.5%, or about 11 centimetres per year. Sometime around 2025, the cube will finally be the size of the tennis court, and the missing 40,000 tonnes is fairly close to the world's unmined gold reserves, so a tennis court-sized cube is a fair image of all the accessible gold in the world, both mined and unmined. But let's switch back to the 20-metre cube, just to emphasise that's all the gold above ground, and it's worth about $7 trillion. This slide shows how that $7 trillion of gold is distributed. Most of it is held as jewellery, and most of that jewellery is of sufficiently high quality that it is effectively out of circulation. People don't melt down golden family heirlooms, or Fabergé eggs, or Rolex watches, because their value is many times the value of their gold content, so most of this jewellery gold is off the market. The world's central banks hold official reserves. This gold is held as large gold bullion bars and supports a currency by providing a deep, or sometimes not so deep, source of credibility. Although these official holdings do move about a bit, slowly transferring from west to east, overall it's been very stable at around 30,000 tonnes for many years. Over the last 8 years, private investment, that's ETFs, coins and bars, bullion vaults, etc., have probably increased by about 10,000 tonnes. This increase has dragged up a stable supply of about 20,000 tonnes of long-term, privately owned gold reserves to much the same level as official reserves, i.e. to about 30,000 tonnes today. That new 10,000 tonnes, worth about $400 billion, represents something like half of mine production over the last 8 years. Most of the rest has gone, as usual, into jewellery. More than anything else, it is this private investment demand which has driven the gold price higher. All the other uses combine to about 12%, which I tend to ignore. In fact, I use the working assumption that gold is industrially useless, and in my opinion, its uselessness is one of its best features. But more of that later. Here's the overview of supply and demand. These are approximations over 5 years, although over shorter time scales the picture can look quite different. The big players are mining supply and jewellery demand, which tend to match each other more or less. Actually, jewellery demand dipped sharply in 2008-09. That was in the first year of the financial crisis, as investment demand took prices out of the reach of the lower end of jewellery manufacturers. 5 years ago, investment demand was nearer 500 tonnes. At 1,300 tonnes, it's consistently a lot higher than that now and shows no sign of diminishing in the short term. You may have seen lots of companies advertising to buy back old gold jewellery at deeply unattractive prices. After 20 years of relatively low gold prices, there was quite a lot of low-end jewellery in the assorted collections of ex-girlfriends whose shopping habits made it necessary to sell, either to eliminate an unpleasant memory or to pay off credit card debt. This fueled a boost in gold scrap supply, up significantly to 1,300 tonnes per annum. This is slowly falling back now, as the back supply of unwanted jewellery has reduced. And with its junk status prices, in my opinion, not too many people will miss this particular service as it shrinks. Although, as I explained on a previous slide, official reserves are mostly stable, there has been some movement. For 10 years, the West's central banks, mostly Europeans, have been selling gold, so they contributed to supply. But the embarrassment of selling the one part of their reserves which has been multiplying in value has staunched the flow of Western official sector gold. At the same time, Eastern demand has been rising, with variously the Chinese, the Indians, Russia, the oil exporters and even Mauritius doing the buying. As you can see, demand has recently had the upper hand, and this, of course, has helped drive the price higher. In this slide, I take a quick look at 40 years of trend in price and production. By the way, this chart shows the year's average prices, which irons out the brief but high peak in 1980 when gold touched $850 per ounce. The first phase, 1971 to 1980, was against a background of stagflation. In this phase, gold's real investment purchasing power went up 15 times. That's after inflation. But then for the next 20 years, gold was in decline. And as other assets like bonds, real estate, equities and the like all multiplied, gold's price was falling. That 20-year period to 2000 was a fantastic time to be growing a business and a rotten time to own gold. That's because inflation was running well below interest rates and business was benefiting from the enormous productivity improvements enabled by the microchip. Strong, healthy economic growth is very bad for gold, and at times like that, your investments should be participating in a growing economy, not sitting on the sidelines in gold. In the third phase, you see the sustained recovery in the gold price. This shadows the increasing monetary recklessness of the authorities, which we'll look at in some depth shortly. The bottom chart shows mining supply. The long increase in annual production was driven by South Africa. However, that growth has fizzled as mines have dug up their easily accessible deposits. The world's biggest producer is now China. It looks likely that the 2,600 tons dug up in 2003 represents peak gold, as my next slide shows. An increased spend in exploration, which has stepped up thanks to rising prices, is not being very successful. In spite of ever more sophisticated technology, big finds are significantly down. The black columns on this slide show how much gold has been found in a year, and the green background shows how much was spent finding it. As you can see, it costs steadily more to find a lot less gold. What this slide doesn't really show is the effect of modern politics on gold mining. 40 years ago, as you can see, you'd find gold, dig it up quickly and cheaply, and retire with a fortune, leaving an ugly and probably polluted landscape behind you. These days, if you're lucky enough to find it, your problems are just beginning. Governments are very cautious about giving mining licenses, and you'll not get one until the local government has extracted cash for roads, schools, hospitals, and a generous budget for landscape repair. Nowadays, regulatory and social costs keep being added until the miner is just about to walk away. Only then, when the government has claimed most of the value, is the miner left with the last $200 or $300 per mined ounce, a sum just about enough to get the mining project underway. But these high social costs are driven up by governments as the gold price rises. And once they're set, they don't fall away if the gold price stalls. That means that too many mines lose out on the early upside of their discoveries, yet suffer dramatic loss of profitability when gold prices dip. And don't forget energy costs, always a substantial element of gold production. Add them to the social costs, and all in all, gold production costs for new finds were running at as much as $950 per ounce in 2010. That's a huge rise over the previous 10 years. Looking at these charts of our major gold miners, you can see what these social and energy costs have done to their share prices, which have mostly underperformed bullion by a significant margin in recent years. That's incredibly important. In the old days, because of their fixed costs and variable revenues, you'd buy mining shares to get extra profit from rising gold prices. That doesn't work anymore. Moving on from the mines, I want to talk about the long-term price behavior of gold. It's a simple but important point that an ounce of gold today buys about as much in the way of food and clothes as it did 2,000 years ago. It has returned to this informal benchmark repeatedly throughout history. Nothing else has been quite so boring as this, but then nothing else has been such a reliable store of value. I suppose the best equities might last a few decades. As for bonds, well, systemic and designed inflation has consistently decimated the purchasing power of bonds throughout the last 100 years. Looking at the current landscape, bonds have rarely yielded less or offered a more certain prospect of depleted capital return. If you like lending your money to a deeply indebted government at 3% per annum, when that government controls a printing press, well, I can only say you're a more trusting person than I am. But while gold is an incredibly stable long-term store of value, the action all happens in the medium term, over periods of 1 or 2 decades. As I mentioned earlier, gold was a poor performer between 1980 and 2000. That's because gold doesn't like economic health. We also saw it perform very well in the 1970s, an inflationary decade. It rose in real terms by 15 times. Perhaps more surprisingly, it also performed very well in the 1930s, a deflationary decade. Some people don't realize that, and it's hard to see it on a chart, but that's because gold and dollars were joined at the hip on the US gold standard. So gold didn't change much in value with respect to dollars, but both gold and dollars performed brilliantly against everything else as equity, bond, and real estate prices plummeted. The investment purchasing power of gold rose by about 17 times between 1929 and 1934. So gold tends to do well in both inflations and deflations, as long as they're severe, and we'll examine why this is shortly. That's my brief introduction to the basics of gold. Now I'm going to look at what's so very broken about our Western economies. I'm going to use data mostly about the US and the UK, but the same arguments apply for most of the Western democracies. For many years, they've run very similar economic policies. I shall be looking at debt, Keynes, and general commodities. Then I shall show the curiously unintuitive relationship between inflation, deflation, and gold, and present you with how I come up with my value for gold. Here is a small pile of $10 bills. This is the world's reserve currency, and anyone who owns it relies on the US government to keep it scarce. Now I will show you just how stunningly badly they're doing that job. You are now looking at an unobscured aerial view of Mount Everest, the highest mountain in the world. You're flying 5.5 miles high, but that's not high enough to avoid the increasing piles of debt. The US government is currently borrowing a column of $10 bills this high every 8 hours. That means 3 such piles every day and 21 per week. They plan to continue doing so for the next 8 years, which is a little over 400 times what you see in front of you now. This is not business as usual. It's very exceptional, and a huge proportion of currency meltdowns start with this descent into excessive national debt. Your political leaders are telling you that this is okay, because in the past we've been in even worse debt. Let me show you the nonsense of that argument. This chart shows the extent of political self-delusion going on here. I'm suspicious of published gross domestic product figures because there's a motivation for adding new stuff in every year to create statistical growth as a substitute for the real thing. But let's ignore that and take the blue line here at face value. It's the official measure of US debt as a percentage of GDP, and the chart spans 80 years. Look now at the pink line on the right-hand scale. This is private sector wages as a percentage of GDP, what I think of as the taxable private sector. It's descending steadily from 44% to 36%, which indicates a steady trend of nationalisation in the US economy. And notice how it's dipped sharply to a record low of 36% last year. This shows the reducing capacity for wealth generation from the private sector, and that's the only source of wealth to pay back the national debt. Now, politicians are telling us that the current level of debt is recoverable because, they say, in 1945 the situation was worse and we recovered from that. Well, we did. But notice that huge 1945 demobilization spike on the pink line. 10 million soldiers came home from war and were ejected from the public payroll and bundled into the private sector. Of course the budget position improved, just as it would now if we ejected 10 million people from the public payroll. But there's no political will to do this. There are other important things to remember. At the end of the Second World War, America was emerging from austerity, not excess. People were spending their war bonds. We don't have the same source of demand now. Far from it, because the opposite of war bonds is credit card debt. Our plastic cards are future consumption brought forward, not current consumption delayed. And look at that 2009 level of debt, remembering those huge piles of $10 bills I showed you on the last slide. Those piles weren't debt we already have, but the plans for yet more debt. The politicians are planning for the debt to shoot upwards, not downwards, and for another 8 years. President Obama certainly doesn't appear to intend reducing the size of the state. That's why public debt is scheduled to rise over the next 8 years from about $13 trillion to about $21 trillion. That's a massive rise, which makes it incredibly difficult to believe this debt to GDP ratio is coming down. So the modern comparison to 1945 is a self-delusion. Lending to government in 1945 was like lending to a company with a sound business plan, and you got a real return on your money. Lending to this one is like lending to a company without a business plan, at a rate which guarantees you a loss, and in the certain knowledge that this government has a printing press, which it's already shown itself to be more than prepared to use. This is a banana republics approach to debt. It's because we're going to such unknown ultra-high debt territory that we need to understand, as a matter of urgency, the level at which lenders stop lending. This is essentially what's been happening in Greece, Ireland and Portugal. That's what we're about to investigate. But I just want to summarize this slide. US public debt is currently at about 93% of official GDP and rising. That's important, and I want you to make a mental note of it as we come to my next slide, a rather dull picture of the cover of a very important book called This Time is Different. In This Time is Different, Reinhardt and Rogoff have produced the most detailed analysis ever of what happens in high public debt economies. It's a frightening book by reliable academics which, by examining the fullest historical record, identifies the common causes of financial crises. The book is beautifully summarized by Professor Neil Ferguson, the TV personality, historian, and now Harvard professor, which is why I put a link here to his summary. The key lessons are, firstly, that when debt to GDP is greater than the key level of 90%, your country is likely to pay a heavy price sooner or later. And yes, that's the number the USA has just gone through. Secondly, convinced Keynesian policymakers believe Keynes works, even at these enormous debt levels. But the historical record says it doesn't. Thirdly, the only viable exits from this are default and printing money. The euro has been showing the signs of impending default because there's no basis within European alliances for forcing Germans to pay everyone else's debts. Recently, both the US and the UK have been celebrating not being the euro. Let's be clear why this is such a relief. It's because they can print their way out of debt, which is exactly what both are doing with quantitative easing. Fourthly and finally, these situations tend to wipe out bondholders, who lose all their money, either to default or to printing and inflation. I want to explain on this slide why you can't just use more debt to get out of trouble. The problem is that you quickly end up without any space to operate a counter-inflation policy. Let me explain. Paul Volcker used to have Ben Bernanke's job as chairman of the US Fed. In the early 1980s, he had to get inflation back under control, which he did by the textbook method of raising interest rates to 18%, which was about 4% above the then level of inflation. This gave savers a real return on their money and encouraged them to ditch gold and save with dollars again. But when he did this, the US public debt was about $700 billion. This year, the US public debt will pass through 20 times that, at $14 trillion. Now look at the effect of even 6% interest rates. 6% of 20 trillion is $1.2 trillion. Divide this sum by the number of US households, about 110 million, and you get an amount of almost $11,000. That's the amount of tax the government would have to charge a US household every year just to pay the interest at a mere 6% per annum on the national debt. This is an impossible amount to collect, but it gets worse. If rates were even approaching 6%, all the bondholders would already have lost lots of capital to rising yields, and they'd certainly see that at 6% the country would be irrecoverable. So they'd demand still higher yields. They'd demand 8%, which would make things worse still. Then they'd want 10, then 12, and you'd be in the middle of a full-blown currency crisis. Again, this is familiar territory to the weakest Eurozone countries. The point is that when public debt gets this high, governments will always find a reason not to run a meaningful counter-inflation policy. They can't so much as give a whiff of rising rates because it sets in train a vicious circle which is impossible for them to control. But on the other hand, with low rates, governments struggle to get people to lend them money. So what do? They start printing it and lending it to themselves. This is a stage we've already reached with quantitative easing. This is absolutely typical of what Reinhardt and Rogoff and Neil Ferguson are trying to warn us about. Just like subprime borrowers, governments are recklessly over-leveraged. We've got subprime governments with debt servicing costs that hugely exceed their ability to pay. That's why they keep borrowing. So our governments think they can go on borrowing, and their thinking comes from Keynes. To my mind, Keynesian economies are a bit like Triumph motorbike engines. Both were designed in the 1930s, both were very successful, and both are now well past their sell-by date. Let me explain by making two obvious comments about motorbike engines. One, we expect them to use fuel or energy, and two, we expect them to wear out. Ed Turner, the designer of Triumph engines, built a great engine which achieved its purpose for about 50 years, but then, as the unreliability increased, people realized they were wasting their time and money trying to save it, so they scrapped it and invested in a new one. Keynes' model economy was also a well-crafted invention, and I agree. It probably saved capitalism from political revolution in the 30s, before underpinning about 75 years of growth. So in a limited way, I'm a bit of a fan of Keynes because his system has left me with the challenge of preserving wealth, which, as problems go, is better than the alternative. But in the world of science, there's a well-understood law which basically says that in the long term, organized systems always fail to failure and disorderly chaos. It's why machines break down, and it applies to absolutely all carefully organized systems. Yet, unlike a biker's sad acceptance of his beloved Triumph's obsolescence, politicians hope the Keynesian system is indestructible. That monumental mistake is based on ignorance of how all complex systems behave. They always fail in the end. I'm fairly sure Keynes always saw himself as a skillful economic engineer, and he'd be horrified now to see his invention treated as some sort of sacred truth by economics professors and politicians. I don't think for one moment he'd recommend stumbling deeper into debt crisis, because he'd easily identify the terminal dangers to an economic system faced with modern levels of debt. Now, as it happens, the terminal danger for the average Triumph engine is the oil leaks, which get harder and harder to control until the damn thing drinks a litre of oil every 20 miles and finally seizes up. That's the way in which I think triumph engines and Keynesian economies are so similar. Here's a picture which explains the leaks in our Keynesian economic system. Did you ever see a penny cascade at an amusement arcade? You drop a coin in the top and it's supposed to push money out of the bottom. When I first saw one of these, when I was about 14, I didn't realise the money disappeared out of the sides too, in the little slots where they don't have any lights. I now realise that the fiendish operators of these machines load up the front edge so that it looks like a pile of coins is set to fall, but the pile is so heavy that any new coins dropped in the top simply force cash out sideways into the dark slots, which isn't where a 14-year-old boy wants to see his pocket money go. We have the same problem with Keynes. After 80 years of careful stimulation, every possible business you can think of has been created. There are thousands of cash-hungry small businesses offering high risk of failure and low potential reward to lenders. This is the ballast weight which is tempting the politicians. But when a central bank puts a pound in the top, instead of stimulating the real economy, 99% of the money escapes sideways into uses with better risk-reward profiles. That's why we see asset price inflation, record bank profits and bonuses, emerging market bubbles, commodity price spikes, industrial overcapacity, overbuilding, derivative speculation, and so on. Our debt has gone up by £1. But only a penny emerges to fund the wealth-generating, job-creating private sector, and at a punitively high rate, much higher than the interest rate at which the central bank made the money available to its favourite city banks. So all we're getting out of our Keynes now is higher debt and stubbornly low growth. That's just what Reinhardt and Rogoff say is typical in the historical data. On this slide, I steal some data from Professor Ferguson's summary of Reinhardt and Rogoff. Very helpfully, Ferguson added into the historical analysis the indebtedness projections for major countries, which are publicly available on the websites of the Bank for International Settlements and the IMF. I'm tabulating the so-called PIGS economies, Portugal, Ireland, Greece and Spain, and I'm mixing in two more important economies, the US and the UK. As you can see, no one ends up with a nice acronym here. The left column shows where we are today. The middle column shows the most optimistic projections from the BIS. Note that these are all well beyond the Reinhardt and Rogoff limit of 90%. The right column from the IMF shows the amount of fiscal contraction as a percentage of GDP we need to impose to get debt back under control again. It powerfully illustrates why we're in such a mess. We have to slash our state contribution to GDP in order to escape a debt-induced collapse. But if we stop pouring in money to the top of our coin cascade, then not only does absolutely no money get through to enterprises, but the leakages stop too. There are reduced corporate profits, reduced investment profits, weaker banks, fewer mortgages, lower house prices, and all round a lot less demand, as well as a lot less tax. So your options are debt-induced collapse or austerity-induced collapse, which isn't a great choice. I guess I'm repeating myself here. You see, it's not just history which says we've gone past the limits of debt. Both the BIS and the IMF reckon we have too. We're past the key 90% level where severe crisis becomes probable, and there's no way back without either debt devaluation or default. Now, although it might not look very closely connected with gold, I'm going to look at one of the major leakages from our Keynesian penny cascade: agricultural and energy commodity prices. There's an underlying theme here, and it has to do with how we become, as nations, much poorer and get the standard of living which our productivity and our currencies deserve. The story starts with the food riots in Southeast Asia in spring 2008, which you may remember. When they petered out, I heard an agricultural economist say, "Lucky the world had a record harvest." So I asked my researchers to look into it. Here's what they found. They took the top 10 high-calorie commodities by production weight, that's rice, wheat, corn, soya, sorghum, sugar, etc., and produced a series of data for total global tons of food output. That is the red line. They also tabulated the world's population, the black line, and world grain demand, the green line. Here are my simple conclusions. Population is rising inexorably. No surprise there, the black line is smooth. Demand is rising faster. That's because Chinese and Indians are eating more as they become richer. And production? In 4 out of 9 years, production fell. But as it happens, the last 2 years were bumper harvests. Unfortunately, a statistician would tell you there's no reliable, observable trend in production. These 2 good years are probably outliers. Now, lots of people in central banks are saying there's little inflation out there, which they use as an excuse to print more money. So make a mental note of this small dip in the 2007 harvest, which set off explosive price rises and food riots, and against a background of these 2 subsequent bumper harvests, look at the following charts. First there's rice, then sugar, cocoa, soya, corn, coffee, cotton, oats, wheat, and last but not least, oil. These charts seem to me to have the same basic shape. Most of them have spiked and settled back at twice the pre-spike value, even after 2 record world harvests. They should have plummeted on record harvests, but they haven't. They've doubled. The genuine merchants in these markets scratch their heads at these price rises. Experienced oilmen know there's plenty about, and they can't see why oil spikes like it does. Similarly, people who know the current world grain reserve situation are surprised by the sharp price movements on not very important stories. That's because they're used to a commercial supply-demand equation, which during their career has excluded the financial effects of monetary easing. But the rules of their game have been changed by the central bankers, and, as our Keynesian penny cascade illustrated, money is very easily available to big investors because they're equity-rich, credit-worthy, and offer low-risk, good return prospects on the cheap central bank money which the big banks can borrow at 0.25%. Many of them pile this cheap cash into commodities markets. On a speaking tour in the US in June 2010, I warned my audiences to watch out for wheat production problems in Australia and Ukraine, clearly the swing producers in the data. Sure enough, when Ukraine had a dry summer, wheat prices spiked very sharply. In November 2010, the second downward revision in US corn and soy yields in a month sent prices sharply upwards. Pepper, tea, sugar and cotton have all had similar stories. Now, because of rising commodity prices, Chinese manufacturers are raising the cost of exports, and major high street clothes retailers anticipate sharp and imminent price rises. This is how central bank money is fueling commodity inflation and high street inflation. Don't believe anyone who tells you otherwise, because they're looking at prices from 2 record production years and comparing them against low yields the previous year. Now, quite apart from the political unrest which we've seen rising sharply again, let me show you the surprising inflationary effect of this spiky price doubling. This slide shows how superimposing the basic commodity price spike produces inflation figures which confuse the hell out of investors and policymakers. All the underlying commodities are in the process of doubling through a spike, but typically they take longer falling back than they do each rapid rise. The result is wild gyrations in the overall rate of inflation. That's the red line. See how it's recorded as falling as often as it's rising. and how frequently it goes negative. In this sample, 3 times, even when the base value of prices is doubling everywhere. In fact, if you think about it, you'll soon realize that the rate of inflation will go down as often as it goes up, even when prices are doubling every year. It's the way the number works, and it makes people miss the underlying pattern. Meanwhile, the Chinese are buying those commodities with the $2 trillion of reserves they've accumulated over the last 20 years. And as they do so, they flood the world with Western currency, reducing its purchasing power. Slowly but surely, our money is buying less on world markets and forcing our living standards down. That's what happens when you sustain your standard of living on $2 trillion of unpaid bills. But in the end, you're forced to shift spending from the wants and desires which dominate a developed economy to the more fundamental essentials of life which dominate a basic economy with a lower standard of living. Engel's law is a guiding principle of national economic behavior. It says rich countries spend much more on services and much less on food and clothing than poor ones do. This table shows how it works. Look how progressively bigger economies have progressively bigger service sectors. Now think of the effect of increased global costs of key commodities, the things we have to buy. As we spend our money on more expensive essential commodities, the big service sectors of our developed economies get squeezed. That's why service businesses can neither make profits nor raise prices. In fact, most of them are having to drop prices to generate enough business to stay alive. That's why reported inflation which looks at our historically typical personal expenditure, stays low. It's got a mix of essentials, which are all going up, and non-essentials, which are falling. But we're not buying the things which are falling because we can't. The British coalition government has been credited with making a valiant effort to get its debt in order. And although they haven't actually made any cuts yet, they're talking a good game and have announced deep cuts to some big services which people benefit from directly. A typical British middle-class family is currently adjusting its consumption to take account of the planned loss of child benefit income and the tripling in the cost of university education. These too early cuts in government spending account for a very significant slice of a British family's discretionary spending power, and, as it happens, a very insignificant slice of the nation's debt. But as we take the axe to state spending, that family simply can't afford the discretionary services which dominate a rich economy. So demand for services stalls. Seeing our reduced demand, the response of government is yet more stimulation, with quantitative easing, more money in the top of our coin cascade. But it doesn't get through to demand for services. Instead, it fuels more inflation in exactly the things which we're continuing to buy. I hope you can see now how all of this combines to form a familiar picture. That's low growth, continuing Keynesian stimulation, growing debt, modest overall inflation, high inflation in the things we actually buy, no increases in salary, significantly reduced Western living standards, and stubbornly high unemployment. We in the West have had a great time in our advanced economies, but our high standard of living isn't a birthright. It's falling apart because we drifted into unsustainable debt. We're becoming high debt, low-growth economies, and our currencies are in long-term retreat, producing a vicious spiral which on the one hand makes vital commodities ever more expensive, and on the other kicks back hard into a struggling service sector. The only truly solid floor to our currency's value is our own productive capability, which will protect us when our production costs are about as expensive as they are in Asia. Unfortunately, that's a long, long way down. Before I show you my gold valuation, I'm going to talk about onions, because our monetary world is an onion of credit. As long as we're being sensible, we only accept money which will successfully store value for later use, so it needs to be very credible. And then, when we've got a credible building block, we start to build new credit constructions out of it, new layers of a many-layered onion of credit. From a solid currency, we get call deposits, term deposits, bonds, insurance, annuities, futures, options, and if you've got a really credible base, then you start expanding into weird things like asset-backed securities, credit default swaps, and collateralized debt obligations. It's in the nature of these extra layers that each is an extension of complexity and of confidence in the underlying building blocks. But sometimes the underlying unit of a series of layers loses its credibility. We saw exactly that with the subprime mortgage in 2008. When that looked shaky, the outer derivative layers fell apart too, and the credit default swaps and CDO asset classes built out of subprime mortgages rapidly imploded. That cost the creditors their money and reduced the onion's size back to a more solid base. The question I'm going to ask now is whether currency itself will fail. The instruments you can still see are the derivative outer layers built out of currency. So if you lose the currency, you lose the deposits, the bonds, the annuities, insurance contracts, and just about everything else. This can happen either through default and deflation or through printing and inflation. Both are currency failure, and they wipe out the outer layers as the onion shrinks back to its credible base. And what is that credible base? Well, the natural properties of gold, its indestructibility, its industrial uselessness, its very reliable scarcity, plus the fact that it's performed this role reliably for centuries, tend to give it a big advantage over anything else. What I hope you understand by my onion is that there are two main ways to lose your money. You can lose it because whatever your money is invested in loses its value, and of course that includes currency. Or you can lose it because wherever your money is employed goes bust and fails to return it to you. When a currency is failing, it could be for either of these reasons, or even both, and whichever it is, the people who own the gold tend to accumulate all the purchasing power in whatever's left. Here are some numbers. What I want you to notice is the $85 trillion bond market. This stuff is the building block of most of our retirement portfolios and annuities. All our careful saving has been assiduously distributed through the capital markets to borrowers of every possible type, and most of it has gone via the bond market. My guess is that before long the bond market will shrivel, and it's going to take a huge slug of Western savings with it. That's not so very unusual that you shouldn't consider the possibility. Bond markets do shrivel. By the end of the 1970s, the bond market was a shriveled runt, and people who'd saved in it had been more or less wiped out. I think that may be about to happen again. You've already seen me looking at why this might happen. Now let's look at how. Let me start by morphing my credit onion to an appropriate scale. These rings are done on area. There's about 34 times as much value out there in the form of bonds as there is combined in public and private investment gold. I like to remind people who worry about a gold bubble at this stage that these two, gold and bonds, were of fairly similar size as recently as 1980, the last time the bond market fell right out of favour with savers. Now, our governments are in a deep financial hole, borrowed up to the eyeballs and with anemic growth after years of stimulation. They've gambled by injecting a few $100 billion of new cash through quantitative easing. Watch carefully and you can see the purple ring, the ring for cash, slowly grow a bit. The immediate result of printing a whole lot of cash is to kill confidence in long-term lending. Once lenders know a government is willing to play the money printing game, they avoid any exposure. That's because the lent money now runs the risk of being returned with a shrug from the government and precious little purchasing power. But it takes a long time for long-dated debt to unwind, so nothing much will go wrong immediately, which sort of lulls the money printers into a false sense of security and encourages them to do it again, as we're already seeing in QE2 and 3. But the damage is certainly done. It's just that there's a time lag before we feel it. When the next batch of once long-dated Treasury bonds comes up for redemption, instead of being lent back to the government for 20 more years, much of it will only get relent for 1 or 2 years. Pretty soon, you've got only half as much long-term debt and twice as much short-term debt on the government's books. Then, steadily, as more and more long-term debt falls due for redemption, it gets replaced with short-term debt. The lending all concentrates at the short end. It's pretty much the definitive train wreck. Look how trusted governments retain a steady debt profile stretching out to 20 years and beyond, which keeps their financing requirement modest and spread out. But as debts get bigger, redemption dates get shorter, which greatly increases the chance of a refinancing crisis. This is exactly what's been the touch paper of crisis in Greece and Ireland. Steadily, as first the 2-year debt, then the 5-year debt, then the 10 and the 20 fall due for redemption, the lenders elect to keep their money on shorter term. They'll accept much lower rates for the privilege of keeping their money at the short end because they won't be poleaxed by future devaluation. So 2 things happen. The money all piles up against the buffers and the yield curve starts to steepen. Let's look at what's happened to the yield curve. A yield curve plots the annual interest you can earn against the amount of time you're prepared to lend your money. The normal thing is that there's a flattish but steadily increasing yield as time increases, so the lender gets more reward for committing his money for longer. These 2 figures compare the pre-crisis yield curves for US Treasuries and UK gilts in 2005 to their shapes in 2010. It's interesting that most people see the steepness of the 2010 curve as an indicator that we'll soon return to the normality of 2005, which means they're expecting growth will resume and short-term rates will rise. But there's an alternative interpretation. The yield curve would look the same if long credit were expensive because of fear of devaluation. This interpretation would mean that our financial markets were taking on the train wreck characteristics, with all the money piling up at the short end out of fear, not out of hope. This has already been happening in places like Greece. But it doesn't appear to have happened, at least not to the same extent, with the UK. There's a bit of a trick going on here. That's because the government is using QE to create long-term debt which no one really wants. The government is using the central bank to hold these bonds. So the apparent health of the debt profile is now manufactured rather than being a natural consequence of free market buyers trusting the currency. Underneath, the light pink shape shows the way free market money is piling up, like Greece. So you see, while the overall shape of issued debt looks flat, it's a bit of a trick. You can see this in the actual data from the UK, which you can derive from the data published by the UK Debt Management Office and the Bank of England. So hidden in the data, we're developing our own train wreck. Even though this new long-dated debt is in fact sold to the banks, they're only buying it for 2 reasons. Firstly, they can finance a purchase of high-yielding, long-dated government bonds by borrowing short-term funds from the central bank. So they earn 3 to 3.5% on money, which is costing them only 0.5% to borrow. That's an attractive deal, but it leaves a risk that they might be stuck on the wrong side if short-term rates started rising quickly. It could cost them more to finance the purchase of the government bonds, than they were receiving in interest. And that's where the second benefit kicks in. QE lets the central bank buy back illiquid, long-dated bonds. This is perfect for the banks because it means the downside of their bond purchases can be exited painlessly. Just chuck the long bonds back to the central bank and you've got your short-term money back again. The banks are making huge low-risk profits from this positive carry deal, which is sort of okay for the government too, because it intends to sell back the bank shares it took control of in the 2009 bailouts, and then tell us how wise it was to rescue those banks. Sure, it'll make a paper profit, but in the process, the government will have got far deeper into the debt hole. In the end, all that's really been achieved is that the private disaster of private banks has resolved to state bankruptcy. Just ask the Irish. Hundreds of billions of long-dated government IOUs create new cash for the government to spend in the public sector. The public sector pay packets get used to do the supermarket shopping. And because nobody trusts it, the money isn't being redeployed as long-term savings. This new money refuses to lock itself into the bond market, and it sloshes around pushing up prices of everything, from internationally priced commodities to productive assets and anything else except money, which is trusted to store value. I'm guessing you can already feel the consequences of this in your daily life. Here's how. The extra quantities of short-term money are increasingly inflating the prices of things you buy with short-term money, like your weekly supermarket shopping and fuel for your car. On the other hand, there's no bank money available for the long-term borrower. That's all tied up in this cosy arrangement between the government, the banks and the central bank. Unless you're starting with a 50% deposit and are prepared to pay a punitive rate of about 8 times the base rate, banks don't want to lend to you long-term, which is why the supply of mortgages is drying up. So of course the shortage of long-term money depresses the price of things you would buy with it, like houses. It's the exact opposite of what we experienced in 2005, when people trusted our currency for the long term. What was happening then was that short-term money was being assiduously collected up by the banks and lent for the long term to people who wanted to buy houses. So the comparative shortage of near-term cash held down the cost of your shopping, and the relative abundance of long-term cash inflated the price of your house. So I hope you can now see the crux of this part of my presentation. Inflation and deflation happen at the same time, but at different ends of the credit period spectrum. But now it's the opposite of 2005. Then, both the ends were benefiting you. Now everything hurts. In a strange way, this all comes back to the microchip. Because productivity multiplied during the microchip's golden age, from 1980 to 2005, we should have seen prices falling by as much as 4% per year. But we didn't. Instead, the likes of Alan Greenspan made hay with the easiest central banking mandate in history. Given 4% productivity growth, pressing prices down by 4% per annum, all he was asked to do was contain inflation at around plus 2%. That's 6% to play with via monetary expansion. So he could let money aggregates expand rapidly through his tenure without inflation exceeding his targets. One of the mysteries of that period was the lack of retail inflation that this loose money generated. As you can now see, a trusted currency, underpinned by growth, caused the inflation to happen in assets financed by long-term money, like houses, because the money expansion was deployed for the long term into the bond markets. And there it still sits, all $85 trillion of it, frozen for the time being in a polar ice cap of savings, waiting for us to find another source of 4% per annum growth to underpin its redeployment to the long end for another 20 years. All that money is still just about frozen for the moment, but it's not frozen solid anymore. As it starts to pile up at the short end, it looks more and more like the loose monetary policy of 20 years is getting ready to melt back into circulation and cause a bit of a flood. That's what we should expect huge piles of debt to do eventually. QE has speeded it up. It is the catalyst which has been added to the mix, and the melting has begun. As I said, there's about $85 trillion still to come. Soon we'll have a few trillion in short-term bonds coming up for redemption into private hands every month. Savers will get mountains of cash and a regular and immediate decision on how to use it. Maybe for a while they'll keep on storing it in short-term debt instruments, but with rotten short-term interest rates, ongoing inflation in consumer goods, and a money-printing government, at some point they'll run for cover into something which stores value better and safer. Let's look closer at the similarities with the Weimar Republic in Germany in 1923, which everyone knows ended in a hyperinflation. What happened in Germany was that the authorities started to print money with the same style of government, bank and central bank cooperation. It seemed like a good idea because they had to pay the hefty reparations which the French were insisting on as a punishment for starting and losing the First World War. But as they started printing, it became more expensive for anyone to borrow money for a longer period. That was because people who had marks to lend were scared of how a long-term loan would devalue while the government printed. Nobody wants the reliable scarcity of their money to be corrupted, so as people stopped trusting marks as a long-term value store and stopped lending marks for the long term, any marks in long-term stores like bonds started to convert into short-term assets. Soon everyone wanted immediate access to their money, so that they could straight away shift their wealth store into some other form, anything which was better trusted than marks now were. That's when the gold price in German marks started to accelerate. But the German government wasn't force-feeding printed marks to an unwilling population. What was happening was that long-term private money was piling up as short-term debt and then converting into banknotes and goods. In the end, even writing a cheque was too long-term for German creditors. It took a few days for cheques to clear, which meant no seller would accept them because of the delay they caused in letting the receiver spend his money. So even current accounts were too long-term and converted into cash. That was what happened in Germany. Let me go back to my onion. Now I'm ready to run another animation. Look closely and you'll see the little injection of cash. That's represented by the expansion of our purple ring of cash. Then all those long-term assets denominated in marks, they're in blue for long-term deposits and green for long-term bonds, gradually converted into short-term debt. Debt which rematerialized into cash every few months. Those long-term monetary assets started to behave like cash. Next, a strange thing. One of the features of the early days of their hyperinflation was strongly recovering GDP. If you looked at production, it looked like the German economy was improving. In fact, there was lots of talk about not tightening the monetary situation for fear of stifling the recovery. Look carefully and you'll see now the light blue core of real wealth expanding a little. I expect you can see why GDP was improving. It was because there was lots of demand in the economy for anything which would store value. Everyone was working like crazy to build and make stuff, so the German economy boasted near full employment until nearly the end of 1923. There was a massive boom in factory building, for example. The German inventory of real assets steadily increased, and all the cash converted at spectacularly high prices into quite modest amounts of tangible wealth. Of course, it was a classic misallocation of capital, because it resulted in huge industrial overcapacity, and none of the assets were of much use when demand finally dived in early 1924. But until then, the government didn't stop it, because they knew what would happen to unemployment. I guess that sounds familiar. By the time it had run its course, all the outside layers of Germany's onion of credit had converted into cash which was worth nothing at all. The cash melted into gold, foreign currencies and factories at ridiculously high prices, and after it had devalued 1,000,000-fold, the currency was abandoned. But the hard, incorruptible interior of the onion survived, and by now consisted of gold plus a few foreign currencies, like pounds and dollars, which hadn't been corrupted. And those who held them became the new masters of the German economy, able to cherry-pick whichever assets they wanted and start building a new generation of business empires. I'm not saying we're doomed to a German-style hyperinflation, even though there are some startling similarities with our situation. Our big banks are cash-rich again. But they're obviously much happier to keep the money concentrated in the short term, where it's as close as possible to cash. So they lend it to super-solid financial institutions with the assured equity to pay them back on demand. That's where all the mortgage money has gone. Hedge funds invest in things like commodities, while the pension funds build our own substitute for Germany's factories, empty office blocks. I'm not sure that we've reached the end game yet. I think it's even quite likely that we'll emerge with a tepid recovery. But I do think we're near the end game, when empires crumble and mountains of savings become worthless. Whether we do or don't emerge into safer financial territory in the immediate future, the problems have not been solved, and the medium-term outlook still looks devastating. In the absence of spectacular growth, there is no good way back from a debt-to-GDP ratio above 90%. I hope I have shown you that one of the possible outcomes of this mess we're in is very severe inflation made uncontrollable by the melting back into cash of $100 trillion of bonds and long-term bank deposits, what I think of as that frozen polar ice cap of savings money. I believe QE will soon be seen as the catalyst which caused the polar ice cap of existing bonds to shift to the short end and melt back into cash. The alternative isn't great. If they stop QE now, government bond yields will go through the roof, so they'll have to slash public spending or default. There is just too much debt. All of which brings me finally to the good news. It looks to me like gold owners will prosper in a world of failing currencies. I explained earlier why, with its incredibly constant supply, it's the wise choice of savers during the sort of currency crisis we can expect. For potential buyers, that still leaves one big problem: the rising price. Markets don't give up their riches easily. Prices move while the outcome is still uncertain and go up to the level at which buying becomes uncomfortable. Everyone likes the idea of buying gold right now, but most decide against it on grounds of cost. After all, it's already come up fivefold. But even with the huge price rise, I bought a lot more gold this year. That's because I'm using a valuation method which quantifies the fair value of gold today, and on my figures, gold is still exceptional value. I'm now going to show you how I came to that conclusion. As my earlier slide showed, the long-run benchmark value of gold is an ounce for a good suit of clothes. That sets a base to which, over the ultra-long term, gold is likely to return at some stage in the future. It'll probably do this when there's a sound economy with good prospects for growth. If that were the situation now, then I'd say gold would be overvalued by 75% today. But gold also offers insurance against many levels of currency crisis, which I and Reinhardt and Rogoff and Neil Ferguson think is increasingly likely. This ability of gold to rescue your finances when things go badly wrong gives gold a valuable premium above this long-term base value. So we need to value gold like an insurance actuary would, in terms of risk-adjusted outcomes. To do that, I need to estimate the chances of different degrees of currency meltdown. So here's my valuation. It's over $3,800 an ounce, And giving you a moment to recover, let's admit that I'm much more fearful of currency devaluation than the market is. You will have guessed by now that I would be. In this valuation, you'll see that it's not headline inflation, but the real rate of return on currency which counts. Is your money on deposit losing purchasing power? Will the monetary system quickly correct to allow your savings to increase in purchasing power? Or, which is my fear, do we expect an extended period of these negative real returns on currency? Negative real rates of return on currency are what drove gold higher through both the 1970s and the last decade. It's obvious, really, because, quite simply, why would you store value in something which doesn't retain purchasing power and has no short-term prospect of doing so? Okay, so let's now see how my valuation works and examine the basis of my numbers. In principle, it's really easy. All I'm doing is assigning a probability to each possible level of devaluation, adjusting for the interest we can expect to receive, and working out sensibly what would happen to gold in each case. I've chosen 13 bands to cover all the devaluation possibilities. The ounce of gold I buy today is a bit like backing all the horses in a 13-horse race, each of which has a different chance of winning. But it seems to me the bookies have got their probabilities wrong, because my expected return at $3,844, and that's expressed in today's money, is far above the outlay I make by buying gold today. Let's look a little closer. The first column is just a list of my 13 bands. The next two columns show you what that currency depreciation means in terms of the more familiar measure of annual price inflation. So if you look at the middle line, which represents our currency losing somewhere between 50 and 60% of its purchasing power over 15 years, that's equivalent to an average annual rate of inflation of about 5.18%. Then in the two white columns, I estimate the probability of this particular inflationary outcome and what I think it would mean for the price of gold. So, still on the same middle line, I estimate a 17% probability of 15 years of devaluation ending up at somewhere between 50 and 60%. Don't worry, I'll come back to where I got this probability in a moment. Clearly, the sum of the probabilities for all the bands must equal 100%, which you can see it does. Back to that central line. If that currency devaluation plays out, because it's quite a lot more than the market is expecting, I estimate that the price of gold would rise by 90% in that period to $2,660 per ounce. This looks like a stab in the dark, but actually there's some confirmation of how cautious I'm being. Look at the next column. Given this level of inflation, the base value of goods, that's consumer goods like food and clothes, would also have risen, which means my base value of gold should have risen too, to $1,778. So my overvaluation against the base level would be only 50%. That's fairly conservative. Look up and you'll see that the current overvaluation of gold, because of monetary concerns, is 75%. So at 50%, I'm anticipating a lower level of overvaluation in the future, even though I think the monetary concerns would be much more severe with this higher level of inflation. In 1980, which was against a backdrop of inflation in the high teens, the overvaluation hit 240%. I don't get to that degree of overvaluation until the band with inflation at 29.3% per annum, which is well into hyperinflation territory. So again, my overvaluation is low compared to history. I think this shows I'm being sensibly conservative all the way up the scale for expected gold value. Next, to value the outcome of an uncertain event, we multiply its probability by the outcome value, which gives me $452. But that's the value from just this one possible outcome. Now, we intend adding those probability-weighted outcomes up. But first we want to take account of what we'd otherwise have done with this cash. This is the opportunity cost, which is basically the deposit interest rate, and it allows me to factor in the effect of negative real returns. Instead of adding the deposit return, what we usually expect with interest, we're going to discount our outcome by the opportunity cost, which means our gold value will come down so that the numbers in the rightmost column will be expressed in today's money. Only by doing this can we sensibly compare our computed future valuation with today's price to tell us if today gold is cheap or expensive. In working out these rates, I'm guessing a future of low valuation with solid interest rates will only happen if we've had a massive productivity boost from some new technology. Then investing in general will be profitable in real terms, and this will come through to depositors as a real rate of return of plus 4%. As you can see, the real rate of return is just the opportunity cost, which I'm highlighting in blue, less the rate of inflation, which I'm highlighting in red. You'll see that the blue column, less the red column, produces a positive rate when inflation is low, but a negative rate when inflation is high. That's what usually happens. Reinhardt and Rogoff draw attention to just how frequently high inflation lets governments steal your savings. For example, by capping deposit rates and by forcing savings institutions to buy government debt at low yields, allegedly for your safety. As it happens, the British government is already doing both of these and, which is still more misguided, it's planning to force you to invest in pensions, which it then forces to invest in its own bonds. This is exactly how pensioners in banana republics end up with a retirement income which buys them a sandwich a month. But anyway, back to the sums, because we're nearly there. The next column says, after discounting by the opportunity cost, what is our gain or loss predicted at? As you can see, a gold investment loses you money in all the outcomes with a positive real rate of return on cash, as you would expect. You can see from my figures that what I estimate as the most likely devaluation outcome gives us a reasonable real gain on gold of 52%, with a probability of 21%. But while things are uncertain, there's lots of value in the other outcomes too. So when we finally add up all my discounted, probability-weighted outcomes, these are listed in the rightmost column, you get to my expected return from backing all the possible devaluation outcomes at once by buying gold at today's price. The answer is surprising and yet not surprising. As I've explained in some detail, I fear we're heading towards some form of rapid currency devaluation. So using my chosen probabilities, I come out with a present value of $3,844 an ounce. That's much higher than the market price, which means that compared to the market at large, I'm either overstating the probability of currency devaluation or overstating the effect on gold prices, should that devaluation occur, or understating the opportunity cost. Those are the various values I've used in the white columns. But I still think I've been cautious all the way. For example, in coming to my inflation figures, I looked at the history of inflation over 15-year periods from the British Office for National Statistics. Excluding the bottom three rows on this model, which I'll come to in a minute, inflation probabilities calculated from historic data were actually worse than the estimates I give here. And that's based on what happened during a period when the public finances were not in crisis. That leaves those bottom three lines. In the historic data from the ONS, these had a probability of 0, because we haven't seen a hyperinflation in the UK in the last 60 years. So where did I get my numbers? Well, I looked at 200 years of data on 14 significant world economies from Reinhardt and Rogoff's book. And the a priori probability of a hyperinflationary event that I got from that was also higher than the figures I'm using here. So even here I'm being sensibly cautious. There's even an external validation of my caution, from the Financial Times no less. Its New Year Lex column gave a probability of 20% for the style of bond market collapse I've been describing, and that's just in 2011. Because I'm looking at the probability of such a disaster occurring in any of the next 15 years, this makes my probabilities look very, very low indeed. So all in all, I think I'm making properly cautious estimations, which means I'm erring on the side of undervaluing gold, even at $3,844. My old mathematics tutor used to make me show my working, so on the next two slides are the data I used to evaluate inflation and hyperinflation risks from historical data. Here's the basic inflation data. Over the last 45 years, this shows the ranges in which the aggregate of 15 years of currency devaluation actually happened. I must say, I was quite surprised to see that in 10.9% of cases, sterling lost between 80 and 90% of its value in the prior 15-year period. But that is the joy of a fiat currency and what passes for almost normal in our modern world. I smoothed this data into a curve in my valuation. You can, if you want to, plug the measured values in yourself, but you'll see it doesn't make much difference to the result. And here's the data I took from Reinhardt and Rogoff to estimate the a priori risks of experiencing a hyperinflation in a material economy. Now I know what you're thinking. He included Germany, Russia, Argentina and Brazil. Well, of course I did. These became national basket cases when they entered into the state of political denial on public debt, just like our own governments are doing now. So I believe they should be there along with the safer countries. In fact, maybe I should only include countries which flirt with national bankruptcy in the way we're doing, which would make the hyperinflation probabilities much higher. The main data shows the probabilities for inflation in any 1 year. What you can see in the red box is the probability of experiencing these extremely high levels of inflation at least once in a 15-year period, which is the length of my analysis. Given these, I think you can see just how conservative are my estimates of hyperinflation probabilities. But with me at $3,800 and the market at $1,400, I guess I must be wrong with my data. There's no way the market could be this far out, is there? It's not full of dumb people after all. So my next move was to modify my predictions in order to get out a value of about $1,400, pretty close to the price of gold at about the time I first used this model. On this slide, notice how much lower the general currency devaluation predictions are. To get $1,400 gold, I've given material chances to rates from 30% down to 0, which now cover 16.5% of the outcomes, even though we've not once experienced inflation that benign in 60 years. But more importantly, note the minuscule contribution of hyperinflation. I've reduced the contribution of the bottom three lines essentially to 0. I don't think this is realistic. In fact, what this illustrates is that at $1,400 an ounce, the market may be making exactly the same error it made with subprime borrowing, which was to assume a probability of 0 for an event which nobody has direct experience of, which in that case was widespread default on mortgages. That's a typically human error to make with probabilities, but we know now how wrong and costly it can be. Again, still trying to get the value down to 1,400, I still had to make some fairly brutal opportunity cost assumptions. The current state of play is that real rates of return on cash are negative and the markets see them staying that way for a prolonged period. I've made them positive for my 5 most benign situations. That's consistent with a return to strong and sustainable economic growth, which is only going to happen if we outproduce Asia. I don't see that happening. So to summarise the slide, I think that bearing in mind the backdrop which I've spoken about at length and looking at the data itself, the assumptions necessary to value gold at $1,400 are far too optimistic on the prospects for our monetary system. In other words, so far as gold is concerned, the market is underestimating the risk of both serious and hyperinflation. My last check was to convert the model to a 1980 view of the world. So let's see if this model would have worked then. I started by setting back the base value to $250, the price of a good suit in 1980. In those days, you'll see there were high expectations of inflation. We'd been living through a decade of it in the 70s, with inflation often hitting the teens. So it's not surprising to see gold discounting 6.76% as the most likely inflation rate over the coming 15 years, and also maintaining a huge premium of 240% over its long-run base value. As you can see, the model was suggesting that any improvement in inflation outlook would see you lose money. And in fact, anything below about 9% ongoing inflation suggests a loss after 15 years. Another interesting variation was that in this data, there's very little premium for hyperinflation in the bottom three lines. I think that was right, because there was no government debt problem at the time, and that made hyperinflation very much less likely. In fact, you'll see I came out with a value of $655. As it happened, the market was wrong in its inflation forecast. The US inflation rate dropped from 14.16% to 2.86% over the next 15 years, very much lower thanks to the productivity miracle of the microchip. As you can see, the model does indeed predict the big loss of value by 62%. But it only gives it a probability of 2% for this deep fall in the rate of inflation. Hindsight is a wonderful thing. But it was a brave soul who in 1980 would have predicted a sustained period of reducing inflation to that extent. Of course, what also happened in 1980 was that Paul Volcker took on inflation by hiking interest rates and plunged the West into the deep recession of the early 1980s. But as I explained earlier, the huge extent of public and private indebtedness we now have probably eliminates that Volcker option. And even if Ben Bernanke switches direction, I don't think it matters for gold, because with the much larger credit onion we've now grown, the resulting depression, which he's trying so hard to avoid, would eliminate consumer wealth, destroy huge sections of the Western world's banks, push governments into default everywhere, and leave physical gold owners with the same circumstances they benefited from in the 1930s, a severe deflation which multiplied their investment purchasing power 17-fold. As I see it, gold has one main future enemy, an imminent productivity miracle powered by some innovation like the microchip, which transforms the business world. It could happen, but even that has a problem. It requires us in the West to exploit it ahead of the Asians, which would allow us to maintain our massively higher standard of living. I believe it's more than likely that if we did find such a miracle invention, modern Asians now enjoy sufficient technical parity to be the ones to take advantage. Even a Western company would choose Asia to develop and manufacture because the cost of British, European or US production remains exorbitantly high by comparison. On that note, I present my final slide, which gives you details of where to download the model and play with it at your convenience. That's it then. I hope I've shown why I believe gold is worth a very great deal more than the price it's currently trading at. I value it at around $3,800 an ounce, which is why I'm delighted to spend my spare cash buying gold at any trading price materially below that. Do please download my spreadsheet, apply your own variables, and calculate your own value for gold. Armed with that essential yardstick, I hope that you'll find it easier to ride out the occasional sharp corrections which are inevitable in any market as the hot money periodically gets cold feet and runs for the exit. To me, those are the buying opportunities, at least until we see a fundamental change in policy direction. I'll finish with a quote. Martin Luther King once said, "The arc of the moral universe is long, but it bends towards justice." I've often thought of that wonderful phrase in the context of Adam Smith and John Maynard Keynes. Smith believed that ultimately government meddling with the economy is always doomed to eventual correction. The work of Keynes showed the power of men to manipulate our world as engineers, and his methods have held in check for 80 years the harsh, long-term economic reality of Smith. Indeed, all of us who have some savings owe our good fortune to Keynes, not Smith. But I think the economic universe also has a long arc, and it bends towards Smith. Ultimately, that's why $85 trillion of Keynesian debt is going to turn to mush and wipe out all our savings and all our debt too. I don't get too depressed about it. This is what always happens to oversized piles of debt. And it's what prevents the next generation from being saddled with the huge interest bills left by their foolish parents. If you buy some gold, my guess is it will contribute more to your comfort in old age than more traditional saving is likely to, as well as leaving your own children with something on the plus side of the ledger. Thank you very much for listening.